Hey everyone, in this video we're going to be looking at trading wedges, both rising and falling wedges. This is probably the most recent pattern that I have added to my tool belt as a trader, and it's been very helpful. We're going to be looking at the highest probability setups for these patterns, as well as how to establish our trade game plan and the appropriate risk and reward. So what is a wedge? A wedge is a pattern where the breaks start to lack follow through as one side that has had control starts to lose momentum. So that is a rising wedge, has bull breaks that lack follow through straight into consolidation when we break bull, and a falling wedge has bear breaks that bounce right after the bear break takes place, showing a lack of follow through. And it's an exhaustion pattern. It shows that the direction that has had control of a trend is losing momentum, and the highest probability for these wedges to play out is when they fit in line with the longer term time frame's most likely scenario. And when we look at some examples here in just a moment, I'll explain that in more detail as far as knowing when the more probable scenarios are shaping up. So with these patterns, stops are triggered right before the reversal, and a lot of newer traders get really frustrated by that. And if you are unable to recognize these wedges, or if you have not practiced them, that's one of those scenarios where newer traders say, my stop losses always trigger right before the move takes place in the direction that I was looking for. So it's important that we recognize when this pattern is shaping up so we can adjust our stop losses and trading game plan accordingly. So here are some genetic versions of the pattern, and you might be looking at it and saying, well, isn't that a counter trend pattern? And it is a counter trend to a short-term pattern, but again, that's where the longer-term time frame comes into play. We can see on this rising wedge here, we are in a longer-term drop leading to a short-term uptrend. The bull breaks lack follow-through. We can draw trend lines of support and resistance that converge, and then we bear break and continue to follow through with the longer-term downtrend. And the falling wedge is the difference, where we have a bull move and we're in a longer term uptrend, and the consolidation on the longer term time frame is a downtrend on the shorter term time frame. So again, let's just pretend this is an hourly breakout taking place, but these are 5-minute candles. So we've just broken out on the hourly, and now we've got 5-minute consolidation. Nice and contained, lower highs and lower lows. Yes, we are breaking support, but every time we break support, we get into a bounce, and then eventually it breaks bull for the continuation of the hourly uptrend after a period of consolidation on the shorter term time frames. So let's now look at some examples and talk about how to establish your trade game plan and where to put your stop losses to ensure that you don't stop out right before the move takes place. So the first example we're going to do here is a falling wedge, and I trade these more because one of my edges as a trader is oversold bounces, and falling wedges often mark bottoms before bounces take place. And again, the most important thing you want to be doing is starting your analysis with a longer term time frame, determining the most likely scenario, and then we zoom in for clues that the shorter term time frames are developing a pattern that is in line with our thesis of what is the most likely scenario on the longer term time frame. So here is AMC on the weekly chart. And in my opinion, the most likely scenario on this weekly chart after this immense volatility is an equilibrium. So we had a breakout, we topped out, a significant pullback with a lower high every single week. That pattern broke, our higher low was set. We then set a lower high. So I am now scouting for a weekly higher low compared to 28.91, anticipating the potential that we will continue a weekly equilibrium with a higher low, and then probably another lower high and a continued tightening range for another couple of months. So I'm scouting a weekly higher low. Okay, what do we need for a weekly higher low to be set? We need a confirmed daily trend change back to the bulls. So I see this big time bull move on the daily. I say, okay, that's a good start. Big time move up. Now, if we're going to set a weekly higher low, we must confirm a daily trend change with a higher low and higher high. So I see the big bull move. I see our base of support, and we start daily consolidation. So after a few days of daily consolidation, I now begin to scout a daily higher low above 33.74. Because again, if we're going to set a weekly higher low, we must confirm a daily trend change for that to shape up. So I'm scouting a daily higher low, and anything above 33.74 is a daily higher low. So what's going to help me determine that a daily high or low is forming? A shorter term time frame. I zoom in. I zoom into the hourly chart. And this is the setup of the trade that I was looking for. It's an hourly falling wedge. We have the hourly lower highs with a downtrend resistance line with a range getting tighter and tighter. And I would draw that using the real bodies of the candlesticks. We've got another video about drawing trend lines, but I use real bodies. So no candle is closing over this downtrending line. And I was watching for this bull entry on October 6th, back on Wednesday. So what stood out to me of this pattern is we had a low of October 4th. We broke that level the next day, October 5th. Look at how much we broke it by. AMC is a very volatile name. It trades 5% moves, 10% moves very easily when that volatility gets going. So we broke support here by 0.5%. And again, it's important to recognize the individual ticker you're looking at because a 0.5% break on AMC is nothing, but a 0.5% break on the S&P 500 would be a lot more meaningful. So again, you have to know what the volatility is of the individual name that you're looking for. And that also helps how much wiggle room we're going to give, which we'll talk about in just a second with regards to our stop losses. So 36, 33, we break it by 0.5% straight into a bounce, and a big bounce. That's a 6% bounce. But fail follow through. So we fade back down. We then break 36.19. We break that support level by about 1.5%. First thing the next day on the morning, straight into a bounce. Not a big bounce, but we break support right into a bounce. What would have me negate that this was a falling wedge is if this bear break sees follow through. If we see increasing bear volume and 3%, 4% of follow through to the downside, then I say, okay, this downtrending support line is no longer holding, and this is not a falling wedge. But I saw that bear break with a lack of follow through straight into a bounce, and that's when I started scouting my entry. And I said, okay, that is a big enough bounce from a new low. This is the 5-minute time frame now, and I was watching this bounce. I said, that is a big enough bounce for me to be scouting an entry on 5-minute consolidation to play this hourly rising wedge, or falling wedge, I should say. So I made an entry just above 36 on this consolidation. So where does my stop loss go? Now, a lot of newer traders are placing their stop losses directly below support or above resistance, depending on the direction they're looking at. So if I were going to play by that mindset, I would put my stop right under 35.67. That is not the correct place to put your stop when you're playing a falling wedge, because by definition, a falling wedge breaks support right before bounces. And essentially it's showing us bear exhaustion. So when 35.67 breaks only by 3 pennies here, people aren't piling in short. The shorts already have their positions, and we're reaching an area where there's nobody left to short here, as we've been in an hourly downtrend for the last 4 days, and we're scouting a daily high or low. So what trades are being triggered here? The only thing that's being triggered on a new low of the day are just bulls attempting bounces getting stopped out. So I placed my stop loss on an entry in the low 36s at 35.49. Why did I choose that level? I'm giving a bit of wiggle room, and I'm going under psychological 35.50. 35.50, just a nice round number, and 1 penny doesn't mean anything to me, so I just put my stop right under that psychological number. We hit a new low of the day. As soon as the low of the day is hit, we get a 3% bounce. So that tells me, yep, this is still a falling wedge setup. The bear break sees 0 follow through straight into a short-term bounce. There are 2 different ways that I trade these falling wedges. The first way is the way I did this one. I enter my position, I put my stop under an acceptable amount of risk. Again, it's based on dollar risk and relative to my position size. So let's say I'm willing to risk $1,000 on this trade, and my entry, let's call it 36.10. My stop goes at, or let's call it 36.09 for easy math, and my stop goes under 36.49. So that's 60 cents of risk. So how big a position can I take with $1,000 of risk? I can buy 1,500 shares, let's call it. And if that's a 60-cent loss, I lose $900 on a 1,500 share position if I get stopped out. That's how I factor how big a position do I want to take based on how much risk I am willing to take. Another way to trade a potential falling wedge pattern is a way that I've done many times as well. Generally, if I have more confidence in the falling wedge. And if I want to be a little bit more aggressive, I'll trade it this style. And for me, generally that's oversold conditions, because right now this 5-minute RSI is not oversold as we're looking for a daily higher low. So there will be times where, I'll be looking for an hourly higher low and the 5-minute RSI will be oversold. And that's when I go a little bit more aggressive, because I'm a bit more confident that a short-term bounce is going to take place. But what I will do is, let's say bear break of 35.67 with zero follow through. And I'm just sitting there with an order ready to go. And as soon as I see this bounce start to go with no bear follow through on the new low of the day, I market buy. Let's say I get filled at 35.80. Okay, I'm in at 35.80. I know that we're still in a downtrend, forming these lower highs on, say, the 15-minute chart. So 15-minute chart, I can say, okay, anything under 37.69 is just a lower high, staying in a 15-minute downtrend. That's the wrong day. Here we go. So I can say anything under 36.58 is just a lower high, staying in a 15-minute downtrend. So from there, I can sell a partial position. So let's say I make that entry, and that entry is at 35.80. I can sell half at 36.10 for a 30-cent gain. What's my average now? I entered at 35.80. My average is now 35.50. So now my break even on my half remaining position is under the low of the day. That puts me in absolute complete control of this trade. I'm not even going to go red unless we see a new low of the day. And then selling half, if we drop back down, if I want to re-enter a full position, as soon as we hold 35.64 here, maybe I wait to see if we break a new low of the day. And if we lack follow through again, I make a re-entry of my half position. We don't break the low of the day. And as soon as that bounce starts, I can add to my position. And let's say my average is 35.50 for a half, and I re-add my half, and it gets filled at 35.90. My average is now 35.70. Again, still very comfortable. My break even on a full position now is right down at that low. And again, for newer traders, this isn't the style you want to take. You want to get really comfortable with this pattern before you try this detailed. But I do that very often, where I will enter on a new low of the day, I sell half into the bounce, I re-enter half on a new low of the day, I sell half into the bounce, and that just keeps me in complete control of that trade with a good break-even average. And again, where does my stop loss go? It goes based on the amount of dollar risk that I'm willing to take. And then eventually, once the bull break takes place, then it's a nice winning trade. And I'm in the driver's seat, and it's just determining where I want to take profits from there. So for me, knowing that I'm looking at this bigger picture, scouting a weekly higher low to take place, I want to have a swing position. So maybe I sell a partial position on the bull break, which I did. I sold a partial position yesterday after some follow through. And now it's possible if we drop down to a lower low, we remain in a daily downtrend and I will stop out. But because I sold partial position and I entered in the low 36s, my break even is maybe 35.80 or so, and still green on the trade and comfortable, because it will be a very small loss if we break this daily support and I stop out. But that was just using a falling wedge to establish an entry based on a thesis of a longer term time frame of what the most likely scenario is going to be. So now on our example of a rising wedge. So I use these less, but I will still use them when I'm looking for a most likely scenario to play out. So here's the 4-hour time frame for the S&P 500 on September 28, 2001. I can see on the 4-hour chart here, we just had a big drop. We've lost the bull uptrend momentum. There's a lot of bear volume behind it. And we see a bounce beginning to take place. Inside bar bull break. Okay, bounce is underway. What is the most likely scenario here? I'm scouting for a 4-hour lower high. Why? Because of the size of the drop, the amount of bear volume behind it, and the amount of retracement that would be needed to just V-shape straight to a higher high. That's not likely. A 4-hour lower high is the most likely scenario. So as the bounce continues to play out, I zoom in and I look for details that show me the 4-hour lower high is indeed shaping up and being set. So I go to the 15-minute time frame. And here, back on September 28th, this is the bounce getting going. And I can draw an uptrending resistance line here, and I can draw an uptrending support line. Again, ensuring no candles are closing above or below. And I can see 43.85 and we bull break that level. This is where we were in a tightening range. This is the daily inside or the 4-hour inside bar that we just looked at. It broke bull. We broke over the high of the initial bounce, but only by 6 points, less than 6 points, straight into consolidation. If this is going to negate a possible rising wedge, that bull break follows through, potentially on increasing bull volume. But instead, we bull break on declining bull volume, get zero follow through, and that bull break results in 45 minutes of consolidation. Granted, it keeps the uptrend going, but it's a bull break with a lack of follow through. So that now has my interest saying, okay, now I'm scouting a rising wedge because I have to have that break with a lack of follow through for me to even be looking for this pattern. You know, before that happens, I can't really draw a good rising wedge here. But as soon as it does happen, I have my second anchor point on this uptrend resistance. We then form a 15-minute equilibrium. The 15-minute equilibrium breaks bull. That resistance is broken by 40 cents, 4/10 of a point. Again, a bull break with zero follow through straight into consolidation. So then it rolls over with a clear bear break. As soon as the shorter term time frame plays out, I then have to zoom out to the longer term time frame to then get, back to reassess the situation. And on the 4-hour, after the bear break took place, our 4-hour lower high is set. If I'm short on that rising wedge, I want to see trend follow through on this longer term time frame. I want to see a lower high and lower low to continue that downtrend if it's going to be a big win on that trade. And I can also look for red flags. So here we form a 4-hour higher low. Nope, we're not continuing the downtrend right now. Maybe that's enough of a red flag that I exit my position. Or maybe I sell half and put my stop over that recent high. And if it breaks, then I stop out with a small win. And we did indeed end up breaking that resistance. So we didn't get a ton of follow through on that bear break, but it was certainly enough to, again, be in control of a trade. If I'm top fishing resistance, and again, if I'm taking that trade, my stop is up above these resistance levels. And maybe I'm using 4,400 because if 4,400 breaks, that shows me bull follow through. And again, the size of my position would be based on the amount of dollar risk that I am willing to take if that level were to break and stop me out. So again, the tricky part for newer traders is your stop is not based on a price level of support or resistance. You have to play it based on a dollar amount you're willing to risk, giving sufficient wiggle room. And you have to determine if the individual ticker, I have to give, if I'm trading AMC or NIO, I have to give multiple percent of wiggle room. If I'm trading Apple or SPY, I have to give much less wiggle room because it's a much less volatile instrument. And that helps determine my position size on the trade as well. So after those two examples, let's wrap it up now. Wedges are counter short-term trends, but they are trading with a longer-term trend if you want the highest probability. Sometimes you'll see something that's in blue sky breakout form a rising wedge. And those rising wedges are much more likely to break bullish and keep the breakout going because, again, the longer term time frame is not dictating that a rising wedge breaking bearish is the most likely scenario. So oftentimes they will play out, but I have way less confidence unless the longer term time frame dictates the shorter term time frame scenario that I'm looking for. Their stop is based on the dollar risk you're willing to take on the trade, not on previous support and resistance levels. You can use them as a rough guide to help gauge where you want to put that stop based on your dollar risk. But again, the pattern is marked by levels breaking with no follow through. And it is frustrated newer traders that are getting stopped out right before the shift in momentum takes place. I personally use partial position flipping to help keep control with a comfy cost basis. Again, this is where it gets tricky because I would not be able to do this as a trader in my first few years of trading. I wouldn't have enough experience. I wouldn't be good enough to do it. But if you get enough practice and you get comfortable enough with these patterns, that's when you can really do well on these patterns by trading with partial positions and adding and taking them off as the pattern continues to develop. When the break takes place, zoom back out to the longer term time frame to determine if there is follow through or not. And we would have gotten some red flags on the rising wedge example we looked at when the 4-hour higher low was established, as opposed to the 4-hour downtrend seeing continuation. Thanks for tuning in. Feel free to check out, or feel free to ask any questions. Check out all the other videos that we got on our YouTube channel as far as some free educational content. And I appreciate your attention.